For a long time, nothing happens. Markets move slowly. Prices drift upward. Volatility disappears into the background. It feels controlled, predictable, safe. And that's exactly when the system becomes most dangerous. Before the 2008 financial crisis, there was no sense of panic. No flashing red warnings. No dramatic headlines. In fact, if you had looked at the data in 2006, you would have seen something reassuring. Low volatility. Stable growth. Rising asset prices. It looked like progress. It looked like success. It looked like the system had finally figured itself out. Then it broke. That's the paradox at the center of modern finance. The moment everything looks stable is often the moment risk is quietly building. And right now, that idea matters more than it seems. Because most people still interpret stability the wrong way. They see calm markets and assume safety. They see steady growth and assume control. They see low volatility and assume risk is low. But in finance, those signals can be deeply misleading. To understand why, you have to stop thinking about stability as protection. And start thinking about it as a transformation. Because stability doesn't just reflect the system. It changes how the system behaves. Let's start with something simple. Every financial system runs on expectations. Not certainty. Expectations. Banks lend money because they expect borrowers to repay. Investors buy assets because they expect prices to rise. Companies expand because they expect future demand. Governments borrow because they expect growth to continue. Everything is built on assumptions about the future. And those assumptions are shaped by the recent past. So when the system experiences a long period of stability, those expectations become stronger, more confident, less questioned. At first, that sounds like a good thing. Confidence fuels investment. Investment fuels growth. Growth reinforces confidence. It becomes a loop, a reinforcing cycle. But here's the problem. Confidence doesn't just increase activity. It changes behavior. When people feel uncertain, they act carefully. They demand higher margins of safety. They limit exposure. They prepare for things to go wrong. Uncertainty creates discipline. But when the system feels stable, that discipline starts to fade. Not all at once. Slowly, quietly, almost invisibly. A bank approves a slightly larger loan. An investor accepts slightly lower returns for higher risk. A company takes on a bit more debt. Each decision seems reasonable. Each one can be justified. Each one feels normal. And that's the key. Nothing about this process looks reckless. It looks rational. But the system doesn't experience these decisions in isolation. It experiences them all together. And collectively, they begin to change the structure of the system itself. This is how stability becomes misleading. Because on the surface, everything still looks fine. Growth continues. Defaults remain low. Prices keep rising. But underneath, the system is becoming more sensitive, more dependent, more fragile. Now here's where things get uncomfortable. The longer stability lasts, the more the system adapts to it. And the more it adapts, the less prepared it becomes for anything different. Think about it like this. If you walk on solid ground every day, you stop thinking about balance. You move faster. You take bigger steps. You assume the ground will always hold. But if the ground suddenly shifts, that confidence becomes a problem. Financial systems work the same way. Stability removes friction. It removes hesitation. It removes doubt. And in doing so, it removes the very behaviors that protect the system. Now layer in something else. Incentives. Because incentives don't reward caution during stable periods. They reward performance. Banks are rewarded for issuing more loans. Investors are rewarded for higher returns. Companies are rewarded for growth. No one gets rewarded for sitting on the sidelines. In fact, being cautious during stable times can feel like falling behind. If markets are rising and you're not invested, you underperform. If credit is cheap and you're not borrowing, you miss opportunities. So the system pushes everyone in the same direction. More lending, more borrowing, more risk-taking. And because stability persists, those decisions appear correct. This is where the illusion deepens. Risk doesn't feel like risk anymore. It feels like opportunity. And that shift is critical. Because once risk feels normal, it stops being managed properly. Now let's talk about measurement. Because modern finance relies heavily on models. Risk models, pricing models, forecasting models. And almost all of them depend on historical data. They look at the recent past and use it to estimate the future. So when the recent past is stable, the models conclude that risk is low, volatility is low, default rates are low, price movements are smooth. The system begins to believe that this is the baseline. But it's not. It's just a phase. And this creates a dangerous feedback loop. Low measured risk leads to more risk-taking. More risk-taking reinforces stability, which further lowers measured risk. It becomes self-reinforcing until something breaks. Now let's make this concrete. Imagine a housing market. Interest rates are low. Jobs are stable. Prices are rising slowly. At first, people buy homes they can comfortably afford. Mortgages are manageable. Debt levels are reasonable. Then prices continue to rise. And something subtle changes. Buyers stretch a little further. Banks loosen lending standards slightly. Lenders compete more aggressively. Not dramatically. Just enough to keep things moving. Because nothing bad has happened. So the system assumes nothing bad will happen. Then it goes further. Investors enter the market. Second homes are purchased. Speculation increases. Prices rise faster. Confidence grows stronger. And eventually, the logic shifts. People stop buying homes because they need them. They start buying because they expect prices to rise. Now the system depends on that expectation. As long as prices keep rising, everything works. But if prices stop, everything changes. And here's the key. That fragility isn't visible in the data. The data still shows stability. Until it doesn't. This pattern doesn't just apply to housing. It applies to everything. Stock markets. Corporate debt. Government borrowing. Stability encourages expansion everywhere. Companies take on more leverage because borrowing is cheap. Investors chase higher returns by moving into riskier assets. Governments run larger deficits because financing is easy. Each decision makes sense. But together, they create a system that only works under stable conditions. And that's the trap. Because stability is never permanent. Now here's where things start to unravel. The system doesn't need a major shock to break. It just needs a small change. A slight increase in interest rates. A minor slowdown in growth. A small drop in asset prices. Individually, these are manageable. But in a system built on expectations and leverage, they don't stay small. They spread. Because everything is connected. If asset prices stop rising, investors lose confidence. If investors pull back, prices fall. If prices fall, borrowers struggle. And when borrowers struggle, the system begins to unwind. What once looked stable, now looks fragile. Confidence disappears. Liquidity tightens. Trust breaks down. And suddenly, the system that felt controlled reveals how unstable it actually was. This is the moment people call a crisis. But the crisis isn't the beginning. It's the reveal. The real story happened earlier. During the years of stability. That's why crises feel surprising. Not because they're unpredictable. But because the signals were misread. Now zoom out. This isn't a one-time event. It's a pattern. After every crisis, the system resets. People become cautious again. Debt is reduced. Risk-taking slows. The system becomes safer. For a while. Then stability returns. Confidence rebuilds. And the process starts again. It's almost mechanical. Stability leads to confidence. Confidence leads to risk-taking. Risk-taking builds fragility. Fragility leads to crisis. And crisis resets the system. Over and over. Now add one more layer. Human psychology. Because this cycle isn't just financial. It's behavioral. After a crisis, people remember the pain. They become careful. Skeptical. Risk-averse. But memory fades. Over time, new participants enter the system. People who didn't experience the last collapse. To them, rising markets feel normal. Stability feels permanent. So they behave accordingly. They take more risk. Trust the system more. Assume it's safer than it is. Not because they're irrational. But because they're adapting to what they see. And what they see is stability. This is what makes stability so misleading. It doesn't just hide risk. It actively creates it. There's an irony here. The better things look on the surface, the more vulnerable the system may be underneath. Because visible calm often masks invisible stress. Now think about today. In many parts of the world, we've seen long periods of relative stability. Low interest rates. Strong asset markets. Consistent policy support. Volatility has often been subdued. Shocks, when they appear, are quickly managed. On the surface, it feels like progress. But beneath that surface, the same dynamics are building. Debt levels are higher. Valuations are stretched. Markets are more interconnected. None of this guarantees a crisis. But it changes the system. It reduces its margin for error. It makes it more sensitive to disruption. It means smaller problems can have larger consequences. And that leads to an uncomfortable conclusion. Stability is not the absence of risk. It's often the accumulation of it. Quietly, Gradually. Systematically. So now we're left with a difficult question. If stability is misleading, how are you supposed to interpret it? Because reacting too early has costs. Tightening conditions during calm periods can slow growth. It can look unnecessary, even harmful. But reacting too late means the system has already become fragile. This is the dilemma at the heart of modern finance. There's no clear signal. No obvious turning point. Each step feels reasonable. Each decision seems justified. Until suddenly, they don't. And by then, the system has already shifted. This is why stability is such a dangerous signal. Not because it's false, but because it's incomplete. It tells you what's happening on the surface, but not what's building underneath. So the next time markets feel calm, when volatility is low, when growth looks steady, when everything appears under control, it might be worth asking a different question. Not whether the system is stable, but what that stability is encouraging. Because in finance, the most dangerous moment isn't when things are obviously breaking. It's when they look like they don't need fixing at all. And that leaves one final thought. If stability can quietly reshape the system into something fragile, then how do you ever know whether what you're seeing is true safety, or just the calm before something much bigger begins?